Hey there, everyone. Welcome to Chart This with Dave Keller. It's Wednesday, November 13th. I am your host, Dave Keller, coming to you from a rainy but beautifully green Redmond, Washington. Thanks for joining me every weekday after the close as we do our best to make sense of these markets using the language of technical analysis. When I think about market movements, when I think about leadership rotation, when I think about asset allocation, and where opportunities may lie, charts and technical analysis are my go-to toolkit to at least understand the environment. And I find a lot of investors get themselves into trouble, not because of a lack of willingness to find good opportunities, but just a lack of awareness, right? A lack of awareness of what's happening. And more often than not, I think one of the worst things you can do as an investor is hold on to something as it does quite well for you, but then continue to hold on to something as it no longer does well for you, right? And holding stocks and ETFs that help your portfolio and help you outperform are good. Continuing to hold those names after their due date, after their expiration date, when they start to hurt your returns or start to contribute to underperformance, that's when we need to acknowledge that the position is no longer working for us. And I would say charts and technical analysis for me are a beautiful way of managing that potential downside risk. I would say, given the environment we've seen so far this week, from Monday, Tuesday, now into Wednesday, now that we're getting some more economic data coming out, CPI came out earlier today, I would say, again, the market overall is still in a primary uptrend. We continue to make new highs, higher highs and higher lows on a lot of charts. All of that's bullish, right? From a trend following perspective, the trend is strong. But if you ask me, are you seeing any things that make you concerned about the sustainability of this uptrend through the remainder of 2024, I would say, why, yes, I do identify some of those things. And hopefully in the show today, we'll highlight some of them, not all of them, right? And hopefully you'll pick up on when I see a dramatic rotation in evidence from bullish to bearish. I will make quite a bit more noise than this. These are just initial warning signs. Things like on a day like today, a lot more stocks going down than going up, which is something we saw yesterday as well. These are some of the things that tell us we're at a potential leadership rotation. At the end of the day, anticipating things is fine. Defining the trends and following the trends is what's most important to me. I hope through the course of our show, we're able to help you stay on the right side of the trends more than you are not. With that in mind, let's get to our market overview and talk about how things played out today. The S&P, a big unch burger, as it were, from yesterday's close to today's close. Yesterday, we closed right around 59.85, and that's pretty much where we found ourselves today, a full 1.4 S&P points above yesterday's close, or 0.02%, literally almost exactly unchanged. The Dow was just slightly higher. The NASDAQ composite slightly lower. Overall, this was a choppy day, but at the end, did we do anything directionally for the major averages? We really did not. Now, if you look underneath the hood at like the mid-cap and small-cap indexes, there was quite a bit of deterioration. The mid-cap index actually sold off through the course of the day. The small cap index sold off through the course of the day. So again, when you ask me, are you seeing any kind of traditional warning signs that would tell you, even though the benchmarks are holding up, things are starting to not look as attractive? This is why looking at market breadth indicators, looking at the performance of small caps relative to large, can give you some early warning signs, because a lot of times, if there is going to be a significant downturn toward the end of the bullish phase, you see investors rotating out of risky positions, rotating into more defensive positions, at least more large and stable positions, which means mega caps tend to outperform small caps, and small caps actually start to sell off. And again, we're seeing that through the course of this week so far. Yesterday, small caps led the way lower. Today, more of the same, with the S&P 600 small cap index finishing the day back below 1,500. Now, the VIX continues to come down, right? So the VIX is now down into the low teens, right around 14. It's down from sort of the upper 14 range at yesterday's close. So we're continuing to see volatility come in. We're not really seeing warning signs in the form of a spike in volatility in terms of a spike in high yield spreads or corporate spreads, right? Indicating that bond investors are getting nervous. I would argue we're not seeing any of those. But we are seeing some initial warning signs in the terms of small cap performance and in terms of market breadth. And we'll have a chart or two to highlight to reflect on the market breadth conditions here today. Interest rates, particularly the longer duration yields, 10, 30-year points, all moved a bit higher. You can see the short end moving lower. So the short end is really more defined by the Fed. That's kind of where they're moving their target right at the very short end of the yield curve. The longer end is more driven by free market forces and market outlooks and economic outlooks and all those sorts of things. So what we have today as the short end is coming down and as the long end is pushing up, we have a continued normalization of the yield curve. As we highlighted on yesterday's show, the yield curve is still inverted or not inverted, depending on what 2 points you measure, right? If you look at the overall shape, it's kind of mixed, right? It's kind of confusing because some comparisons, the 2 to 10-year spread is actually back to a normal shape. The 3-month to 10-year point is actually still slightly inverted, but very, very slightly. It might actually have right-sized itself or normalized itself after today's change. Now, that steeper yield curve, some things tend to, just thinking about what kind of ripple effects that could mean. Banks, financials tend to do better with a steeper yield curve, certainly more of a normal shaped yield curve, because that's essentially their business, where they're able to borrow and where they're able to lend out. And that nice gap from short end to the long end of the curve is how banks are, especially lending banks, are able to turn a decent profit. So the yield curve continues to normalize. The long bond ETF, the TLT, actually came off about 1% today. The dollar index continuing to push to the upside. And we highlighted that on yesterday's show. Stronger dollar, weaker gold, and some of the ripple impacts of that. So if you missed yesterday's edition of Chart This, I'd encourage you to check that out for bit of a deeper discussion on the dollar and gold and interest rates. Looking at the commodity space, you can see gold and silver continuing to feel the pain. We highlighted earlier this week the rotation lower in gold. That's actually happened post-election. Think about the big trends to emerge after the election last Tuesday. Starting on Wednesday, the dollar has been aggressively pushing higher. Gold and silver have been pretty aggressively pushing lower. Gold down only 1% today, but certainly in the last couple weeks, it's turned it from a resilient uptrend and arguably in a consistent uptrend through much of 2024 to a less strong and arguably more of a weaker phase here in the last couple weeks. Depending on your time frame, we were kind of nearing that point where you have to question how much of a gold position you want to have, given the strength that we've seen year to date, and given some of the weakness in the short term. Over time, we're still making higher highs and higher lows. So my long-term investor hat, still quite happy owning quite a bit of gold. But on the tactical time frame, I'm thinking, how much of this downside do I want to participate in before I start to loosen up some of those positions? That's the kind of thing I'm thinking about right now. Looking at cryptocurrencies, you can see Bitcoin continuing to move higher. Now, over the last 12 hours, Bitcoin actually briefly went above 93,000 for the first time, and that's after going above 90,000 for the first time. All of that's happened here in the last 12 hours. We did briefly get up to around 93,000 as we're recording the show today here after the equity market close. We're down just below 89,000. So as I've told many people, sort of considering cryptocurrencies and the crypto space for the first time, I was telling them, if you love the volatility of the most volatile equities, you're going to love cryptocurrencies because it's a lot of noise. It's a lot of crazy movements, a lot of whipsaws. And if that's something you're excited to experience, please enjoy. If you're not prepared for that, do not subject yourself to the volatility of this space. And I think the challenge for thinking about cryptocurrencies is the potential for long upside, trends, given the promise of blockchain and the Ethereum network and all of those sorts of things, but with the volatility, right? And a lot of investors do not particularly appreciate a ton of volatility as a price to achieving superior returns. But that's what Bitcoin's been able to do here in the last couple of years, for sure, coming off of a major low. All right, let's look at the sector returns. You can see actually a pretty decent day for the sector ETFs here in the U.S. You can see consumer discretionary, the XLY, energy XLE, and real estate XLRE all are up about the same time, the same amount, up about 0.8%. Only 3 of the S&P sectors were down. Technology down 1/3%. And I'm looking at the tech space. We'll see the market carpet here in a few moments, but semiconductors continuing to get, in some ways, absolutely crushed. We'll talk about monolithic power systems, MPWR, when we get to our chart review a little later in today's show. Healthcare, number 2 from the bottom, down about 1/4%. Utilities down about 0.2%. Everything else up for the day. Looking down here at sort of the breadth indicators, and again, when I see a market in a clear uptrend, which I think the S&P and the Nasdaq are, right, we're making higher highs and higher lows, and I think that's been the trend for quite some time. I think number one, you accept the trend in its current phase. I have no problem following this trend. As long as the market wants to go higher, I will happily own stocks that give me that exposure. But I am always diligently looking for signs of potential distribution. I want to look for signs that there are investors finally selling into strength, probably the anecdotal smart money trying to unwind positions in a position of market strength and prepare for a potential downdraft. Things you look for are divergences in volume, divergences in momentum, divergences in breadth. Those are the three things you look for. I'm concerned this week by some of the negative breadth characteristics, right? We are seeing a lot of stocks that are actually doing quite well, as evidenced by the fact that the indexes themselves are breaking out. But I'm also noticing that on a day like today that in the S&P 500, there's about a 50-50 split of stocks going up and stocks going down. And the NASDAQ Composite is about a 2-for-1, stocks going lower versus higher, decliners versus advancers. In the small cap space, even worse. So you're seeing a lot of distribution just day to day with a lot of names. And again, that's one day. I don't want to draw long-term conclusions from short-term evidence, but a lot of times the short-term movements will happen first, and as a matter of fact, almost always, and then the long-term charts will reflect that rotation much later once there's been enough of a change that it actually is recognized by those major averages. So I am seeing a bit of a concerning development there. Looking at the Magnificent Seven and Friends, the mega cap growth space that I think is so important to watch just because these are huge positions in our benchmarks. They're big positions in the sector ETFs like the XLY and the XLC. So recognizing strength or weakness here can better prepare you for strength or weakness in the broader indexes. Amazon having a nice strong up day, up about 2.5% today. Netflix up over 1% as well. On the downside, Alphabet, NVIDIA, both down over 1%. And some things to watch as well. Meta is a chart we'll hit on here in a moment because I think that's another one to pay attention to. As we bring up the market carpet, as a reminder, I appreciate you so much wherever you're live streaming this on Facebook, on LinkedIn, on YouTube, and on X. I appreciate you following my work there. As someone suggested, smash the like button. Why not? I actually promised my son, Henry, who watches a ton of YouTube videos about games and soccer essentially, but he told me, Dad, can you tell them to smash the like button? So you're welcome, Henry. I told him. All right. Also, as a reminder, I can see questions that you have on any of those platforms. Really cool thing about the technology we're using is wherever platform you're on, if you put a question in the comments section of that platform, I can see it here live. I'll try to take a question or two at the end. And then anything I don't get to, I'll put into the mailbag, which hopefully we'll get to later this week. All right, let's look at the market carpet. Again, I love a sort of heat map visualization like this one that really helps you appreciate the market on a couple different levels. 3 questions I'm trying to answer every time I look at a visualization like this. Number one, the overall impressions. What's your broad takeaway about the market conditions as reflected in the colors and movements that you see? Number 2, what about the most important names, the big names, which tend to have big weights? You always want to understand what is happening there and identify if there are any potential inflection points or changes in the trend. And then finally, looking opportunistically, looking at more individual names, outliers, things that are having significant moves, and just make sure you're aware of what's moving and what might be actionable. So going through those 3 very, very quickly, I would say at a high level, kind of a mixed day and probably more negative than positive. This is where the negative breadth readings that I mentioned, right, with some of the stocks. And on the S&P, it was about 50-50 between stocks up or down. And that's kind of what I'm seeing here. But again, in a primary bull market, which we're arguably still in, you want to see not a meat map, but a heat map that is more green than red, right, showing that stocks are participating in the uptrend. What you're seeing here is a lot of stocks are not participating in the uptrend, at least today. And even though the markets have been trending higher, we're seeing some selling occur in some of these key names. And that could be a sign of profit taking. That could be a sign of distribution, which may be reflected later in the major averages, but always something to be wary of. So I would say, first off, kind of a mixed modeled sort of heat map, not very homogeneous, very heterogeneous, meaning there are a lot of different colors represented across, to be honest with you, most of the 11 S&P sectors. Second thing to look at are the major names, and I'm immediately drawn to Amazon up 2.5%. Amazon's sort of an interesting chart. I actually didn't save that one as part of the chart review, so I'll just bring it up very quickly. I mean, Amazon making a new all-time high today and powering above the $200 level through the elections last week and continue to go to the upside. If you're all bulled up and you want this bull run to last well into 2025, you need the Amazons of the world breaking out and powering to new highs. And that's certainly what we're seeing right about today, right? We're seeing another move higher. And the concern, I would say, for a lot of stocks that gapped higher last week after the elections, they've kind of stalled out a little bit. And I'll actually highlight some of those like Caterpillar, like Charles River Labs that have had these gaps, but are now starting to fizzle a little bit, right? And instead of gapping and running, they're gapping and falling. And that's less what we want to see. We want to see some follow through. So encouraging that a chart like Amazon is following through. You need more of those. The problem is you have Alphabet coming down 1.5%. Microsoft, Meta, instead of breaking out and continuing higher, Meta has essentially been sideways through the elections, right? So it's not like you got this big upside boost in Meta post elections. It's actually kind of still range bound where it's been for the last 6 weeks or so. So lack of follow through with some of those larger names, I think, is still a very real issue to think about. The third one, just looking for smaller opportunities and themes. And I would say number one in the technology space, it's some of the red boxes that you see in tech. A lot of these are part of the semiconductor space, like AMD, Lam Research, KLAC, Skyworks, MPWR, Micron. Those are all semiconductor names. I'm also noting Intel, which is kind of bucking that trend. Now, Intel has been probably one of the worst charts in the semiconductor space, tends to actually be a very different return profile than most of semiconductors. Actually was down for the first 9 months of 2024, but starting to rally since early mid-September. So that's something to pay attention to. Second thing I would say would be a lot of red in the healthcare sector, right? Charles River Labs is one of the charts we'll talk about, sort of having a nice rally, but stalling out a little bit. Moderna, Baxter, Molina Health, these are all stocks that are rotating lower and arguably in primary downtrends at a time when the market is in a primary uptrend. Final thing I would say would be some of the just random opportunities of names, particularly on a day when the market's flat, right? The market's essentially unchanged. Look for the big gainers on either side, right? What moved up a lot, what moved down a lot, because that tells you they're kind of bucking this sideways market trend and are starting to have significant moves to the upside. Boeing breaking down isn't that new of a story, but that's an example of the kind of major signal I would look for. LDOS down 3.5%. This is coming off of an initial test of the 200 level. This is a stock that's been in an aggressive uptrend through the course of 2024. And I would argue still in a primary uptrend of higher highs and higher lows, but watch when you start to see big down days and look at volume indicators and see if that might be the beginning of something a little further. All right, getting on to our chart review. We start with a daily chart of the S&P 500. And as a reminder, keep your questions coming. I appreciate the questions that I'm seeing come in. I would love to take a question or two at the end of the live stream. And again, anything I don't get to, we will pop into the mailbag. Daily chart of the S&P, I would say, clear, still an uptrend, as we mentioned through the course of this week. The island reversal that we experienced around the elections last week really sort of, reignites this uptrend or redefines this uptrend as a primary bullish phase of higher highs and higher lows. And, when I keep saying higher highs and higher lows, the reason why I keep coming back to that was one of the genius moves of Charles Dow back in the early 20th century, around the turn of the century, was, talking about defining trends by looking at the peaks and the valleys and the price, and whole technical analysis disciplines have evolved from that initial just way of defining trends. And I love going back to the basics in a market like this, because there's so much speculation, so much uncertainty, so much questioning about what could happen and what might happen. Focus on the primary trend, on what actually is happening. The market continues to make higher highs and higher lows. As long as that keeps happening, I'm going to want to continue to be bullish. I'm going to want to continue to own stocks, generally speaking. I don't want to own stocks when we're no longer in a primary uptrend. The fact that we've made a new high, briefly tipping above 6,000 on the S&P this week, tells me the trend overall is up. By the way, I have the S&P 5,000 hat. I might need to make a S&P 6,000 hat. Oh well, we'll get to one thing at a time here. All right, so primary trend in the S&P is up. By the way, we did briefly tap that overbought level through the course of this week. That was actually on yesterday's close. I think that was just briefly there. I don't know if it technically got above the 70 level yet. And when you have that sort of move, you often get like a brief pullback, like we saw that in mid-May. The last time, you just have a brief touch of it, often creates a higher low for the next move higher. Certainly seems with today's action that may be something we're beginning to see. But overall, again, we remain above upward sloping moving averages. The trend in the momentum in the RSI overall is still constructive. Now, the breadth indicators, as I mentioned, starting to be a little less ideal here. We highlighted coming out of the elections, the McClellan oscillator popped back above the zero line, which is a good short-term breadth indicator that tells you that the conditions are starting to improve. But as of yesterday's close, and this is actually updated as of Tuesday's close, not yet for today's close, but given the AD lines, it's probably just going to stay right around current levels or slightly lower. So overall, the short-term breadth now negative through the course of this week. Previous signals like that have often, have been, at worst, significant drawdowns, but often have been just brief pullbacks within an uptrend. It definitely tells you in the short term on that tactical time frame, we might be pulling back a little bit through the course of this week. We'll continue to watch that for sure. Looking at the high yield spreads and corporate spreads, they're remarkably narrow. And one of the reasons why I want to share this chart, we used to joke in the chart room at Fidelity, never confuse the top of the page with resistance and never confuse the bottom of the page with support. We'd often share that when a stock was going down, because a stock would make a new low. And when you look at a charting platform, it always expands the price action to fit the viewable area, right? You want to kind of maximize your ability to see the different patterns. And so whatever range we've been in, you maximize it, which means when a stock is in a significant uptrend, it looks like we're at the top of the page. When the market's in a downtrend, it looks like we're at the bottom of the page. And just because we're at the bottom of the page does not mean we're at a low, right? The market can keep going lower and lower. You're kind of seeing this flipped over with the chart of high yield spreads, right? It looked like around 3% was going to be the lowest level we saw in 2024 until it wasn't. Now we're down to around 2.6%. This is a high yield spread. So a spread of high yield bonds over sort of a risk-free rate, right? Like a treasury bond. And so these spreads have been narrowing, and I plotted upside down on this chart, just like I plot the VIX upside down to more match the general and traditional relationship with the S&P. When spreads are narrow, when volatility is low, the equity markets tend to be in a primary uptrend. That's what we're seeing. So when you think about, what sort of warning signs we would look for, and I actually just interviewed John Kosar of Asbury Research. I haven't published that interview yet. Hopefully, very, very shortly, I'll be able to get that out to all of you. So look for that on my YouTube channel. We had a really fun discussion about a lot of things. He highlighted volatility as an important warning sign to look for, and I would wholeheartedly agree. This is one of those charts I love to watch, right? Until spreads start to widen, until volatility starts to increase, those kind of traditional warning signs from the options market and from the bond market are just not firing, right? And as long as spreads remain narrow, as long as volatility remains low, conditions for further upside are still very much in play. Just wanted to highlight, I might keep the chart of Bitcoin in here every day for a short while as we continue to make new all-time highs every time I bring it up. Bitcoin did briefly push above 90,000 for the first time. We've talked about the upside potential in Bitcoin from a long-term perspective, and I would say what we're seeing here over the last couple of weeks, certainly post-election, completes that rotation out of a large basing pattern that has been the story for most of 2024. And as we talked about during this period, it's all about finally breaking through that resistance and breaking out of that base. I would argue we've now done so. And the history of Bitcoin is filled with these sorts of moves, right? These sort of basing patterns and then breakout patterns. And so it appears once again we're going into uncharted territory, pun intended. And I do own Bitcoin in terms of full disclosure. All right, looking at India, I actually have one of my premium members of Market Misbehavior ask me about India, and I shared this chart, which I'm happy to share with you as well. I often get asked about my market trend model, and I designed that to run on the S&P 500 as a way of just getting a general sense of the movements in the benchmark and making sure that I'm on the right side of things. But again, I frequently will apply this model to other markets like India and elsewhere. I will apply it to different ETFs, different asset classes, and cap tiers, and even some individual stocks, to be honest with you. As long as there's liquid enough data and as long as it tracks sort of the normal technical patterns, I think it makes sense to do so. So what's happened in India, and I'm using the INDA, just the US listed iShares India ETF. You could easily run this on the Nifty or the Sensex if that's if you're more of a local investor, have the ability to invest locally, that might be more relevant to you. But I have no problem with either. I'm just using the India ETF as an example. And I want to highlight, what I would be looking for in the US chart, because India and the S&P have had very similar 2024s, right? The long-term model for India, as far as I'm concerned, turned bullish in June of 2023, and that basically has remained in place to this day. The medium-term model actually briefly turned negative there in October of 23 on this pullback, and has remained bullish until about a month ago, until about 3 weeks ago. It actually went below the zero line. So that tells me, high level to go risk off on India, to be more lightening up on positions, focusing more on capital preservation versus capital growth. When this is above zero, that tells me to focus more on growth, more on finding new opportunities. When it's below zero, it's thinking more about capital preservation. I want to make sure that I ride through the downtrend and survive it and raise enough cash that when the market resumes its uptrend, I have a lot of things to reallocate, a lot of funds to reallocate on the market going back upwards. Now, the short-term model turned negative first, and that actually has had a number of periods through the course of 2024, four times when it actually briefly, maybe five, where it briefly turned negative earlier this year, but then finally broke down for good, or at least for now, in mid-September. So the way that my market trend model works is actually the short-term model will turn negative first, then the medium-term model, and then when things really get hairy, the long-term model would turn negative. So this is the rotation I'm seeing in India. For me, it tells me to be a little more risk off and focus more on capital preservation. This may be a template or a playbook to think about for the U.S. markets that have remained in a primary uptrend. We've had some short-term sell signals, but not the medium-term model yet through the course of 2024. That's the risk. That's what I always look for. And if we would see that in the U.S., that would tell me to get out of the way here as well. But for now, remaining bullish. NVIDIA, I'm recognizing on some of the mega cap growth stocks, again, making a new high post-election. That's encouraging. Hasn't really followed through since that breakout middle of last week. And this week's new all-time high is marked by lower price momentum. So we have new highs on weaker momentum, which is usually a bearish sign. I highlighted yesterday, I think it was Apple's weekly chart showing a similar pattern of higher highs in price, lower peaks in momentum. Major tops often have divergences, so I'm looking to see if those divergences can be resolved. Meta is one of those charts. We talked about Amazon breaking two new all-time highs. What about Meta and others that have failed to do so? Here's your election bump last week. We're still bumping right up to $600 a share and not following through. The kicker with the S&P and the NASDAQ is they are super top heavy. So if a bunch of random smaller consumer names do well, it's not going to be enough to make the major benchmarks move higher. You need the Meta, Amazon, Alphabet, NVIDIA kind of trade to resume. You need those stocks breaking to new highs to really propel the S&P and the NASDAQ to meaningful gains beyond what we've experienced so far. So the fact that a Meta has stalled out tells me 600 is where I have an alert set. Continue to watch that one. And look for if and when Meta is able to break above resistance. For now, still holding out. Wanted to highlight a couple charts that did gap higher post-elections, but have not followed through. One would be Caterpillar, which actually gapped higher and has traded lower. That gap day ended up being the high close for the cycle. The last week since last Wednesday, we've actually deteriorated a little bit. This pattern, by the way, if you know your chart patterns, your candle patterns, by the way, this is not a bearish engulfing pattern, which would be an up day and then a down day where the down day engulfs the previous up day. This is actually called a bearish harami pattern. If you know your candle patterns, we have an up day and a down day, but day one's range is wider than day two. So it's a similar kind of distribution pattern in the short term. It has similar implications. It's a short-term bearish reversal pattern, which so far has played out very, very well. But that's why when a stock gaps higher, I'm immediately thinking, do I see any candle patterns that tell me that gap was just a short-lived kind of fluke thing, and now we're seeing investors selling into that strength? And that's what that two-bar pattern that we observed earlier last week on Caterpillar really told us. Now we're seeing more of that follow through to the downside. Still not a broken chart, but definitely not following through to the upside. Charles River is a biotechnology stock. It actually gapped open opened above the 200-day moving average last week, but traded lower, and that was earnings last week in the midst of all the news flow last week with elections and the Fed. You also did have a bunch of companies reporting earnings, CRL being one of those. Now, it was a positive initial reaction, but that open was essentially the top tick to the last 5 days of trading. From then, we've actually traded lower. And when you have a big gap like that, I always think of the gap as a support level or a support range. We're now back up within or back down within that gap range, which is, a bit of a concerning development, right? When you have a gap higher, you want the stock to run to the upside. You don't want the opposite, which is what we've seen on both of those previous names. Now, semiconductors have gone from looking very good to questionable and unable to follow through to now just downright ugly. And I would say MPWR, probably the best example I could dig up very quickly about that. Look at the new high that we made June, July, August. Things are all going great. We're outperforming. The momentum is pretty good. We did start to note some of these bearish divergences over the summer as those new highs were met by weaker momentum. Then we started to see the stock fail to follow through. And again, the chart of Meta looks very much like this chart, right? And this is why it's one of those warning signs, right? A healthy bull market has stocks leading the way higher, making higher highs and higher lows. When stocks try to make a new high and fail to do so, that can often be the sign of exhaustion because a lack of willing buyers are emerging that are going to create that demand to push the price to the upside. Then the unthinkable, or maybe the very reasonable and understandable, happened. We failed to follow through, and then we really started to gap down. Over the last couple of weeks, we've had a series of downside gaps, undercutting support levels, undercutting moving average support. The moving averages are now starting to slope downwards. The momentum is now in the bearish range, and the relative strength has gone absolutely disastrously lower. So this is the danger that you have when a stock has been in an uptrend and then starts to sell out, is then we enter a new distribution phase. And at that point, a chart like Empower for me is guilty until proven innocent. I am happy waiting until I see signs of accumulation. I'm not seeing them today. Have to finish. I was going to finish with Empower, and then I'm like, that's kind of a sad way to finish the chart review. So let's land on a happy note. Let's look at a Home Depot here, right? There are charts that are working. Classic breakout above resistance, a pullback to the breakout level, which is a pretty well-defined and well-documented technical configuration, pulling back to an ascending 50-day moving average, which overall has held. This is making higher highs and higher lows, and overall a chart like this, I would assume, is in a decent uptrend. Note the momentum on those pullbacks, right? That's what often marks a chart in a primary bullish phase. We pull back to an RSI level around 40. That suggests that the long-term trend, even with the pullbacks involved, the long-term trend still okay. All right. Thanks so much for asking questions. Those of you that came in here, let's take a question or two. Going through some of these. Let's see. Rich, watching on YouTube, thanks so much for streaming there. You said, Dave, you seem to prefer the S&P small cap over the IWN. I think you mean the IWM, the Russell 2000 ETF would be my guess. Would you offer your thoughts on why? So here's the thing. I actually prefer is a tough word to use here. I refer to the S&P 600 small cap index because that's what's on the front page of the market overview that I have up on one of my monitors pretty much all day. Back in the day when I was using other platforms, primarily like Bloomberg and others, where I could hand select what I was showing, I would always use the Russell 2000. There are benefits and challenges. There are positives and negatives to both of those too. In a lot of ways, they're very similar, right? They're both looking at small cap stocks. They have different methodologies in terms of how Standard & Poor's or the FTSE Russell people are selecting stocks and what sort of criteria they have. So you can look into that if you want. I would say the challenge for the Russell 2000 is that it has a lot more junk in there, right? If you think about the S&P has 600 names and the Russell basically has those and another 1,400 names too. And that's generally speaking kind of what's happening there. There's just a lot more room for a lot more junky stuff. So think of the S&P 600 as kind of more of the quality part of the Russell 2000. However, having worked with a lot of institutional money managers, the Russell 2000 and the Russell 1000 indexes were much more widely used as benchmarks. So I spent a lot of time looking at the Russell 2K and sort of digging through there. When I'm looking at ETFs, I actually use the IWM primarily. So I just use that when I'm talking about a market recap, just as a quick sense of, what did small caps do today? For example, the Russell 2000 was down about 1%. The S&P 600 small cap was down about 0.8%. So similar kind of moves. So, just as a quick reference of what's happening in small caps, I think either are probably okay. If I'm really trying to analyze the technical configuration, I use the Russell 2000. I usually use the IWM because it's more widely followed. Money managers I used to work with were much more, tied to the Russell indexes. And so I think that would be fair to do. If you're looking at any particular ETF as an investment vehicle, whether it's the IWM or a small cap ETF or any ETF, I would say, due diligence process is super important. Fees, spreads, volume, liquidity, risks that are involved are all very important as part of that process. The good news about the IWM and other liquid ones is they're pretty popular, but those are some of the differences between the two. And again, the IWM is my go-to. If I'm analyzing a chart of small caps, I would 99% of the time start with the IWM, and I'd encourage you to do the same. It's a decent place to start with. You're asking about IAG. Happy to do that. I'm guessing this is this one, UK company. I'm guessing at this one, International Consolidated Airlines Group. I'm not super familiar with this name, so completely fresh technical perspective here. What's interesting? I was actually talking to someone earlier, a couple of my former Bloomberg colleagues. We were talking about some non-U.S. markets. At times in my career, I've looked a lot at non-U.S. markets, and I've certainly traveled around where people have asked questions about it. The beauty of the technical analysis toolkit, I would say, as long as the data is liquid enough and accessible enough, right? Widely accessible, transparent enough, you can analyze charts using the technical toolkit. That's one of the things that I love about it. Even if you don't understand the fundamental implications and listing requirements and practices of different regions, charts can tell you a lot about which markets are stronger or which ones are weaker on an apples to apples basis. So that's one of the great uses of technical analysis. Rauf, thanks for asking about IAG. And again, have not looked at this chart maybe ever before. So here's my take. So, initial take, I would say, obviously leading into the observation here this week, we're in a primary uptrend. I would start with a weekly chart that tells you, look at the rotation that we've seen through the course of 2024, right? This is a stock that sold off, obviously, in sort of the COVID era, found some eventual stability here in late 2020, but then really has been range bound. And much of 2023 was a sideways period. And now just in the last 6 months, it's been quite a change, right? This is what we always talk about, a change of character, right? A particular trend, a particular phase is now changed. And I would say now you're seeing a primary uptrend, at least on the weekly chart. I would say on the daily chart, go back to the Charles Dow, analysis that we apply to the S&P and other charts. We're in an uptrend of higher highs and higher lows. We're outperforming at least the U.S. benchmark I use, the S&P, which is encouraging. Are there signs to be concerned about? I would say the new high in October on weaker momentum, sort of giving that divergence, was not ideal. But as we reinitiated this uptrend, I don't think that divergence is necessarily as obvious anymore because we've broken out on stronger momentum. So, again, recent gap name, like a lot of U.S. stocks as well. With this sort of chart, I immediately, what I do, and I'll show you exactly what I do, and then I probably need to stop the show here. Sometimes you get going, you just want to keep going. What I like to do is use on stock charts, and other platforms probably have a similar way of doing that. I like to kind of draw a little, range around that gap. I like to sort of save those on the chart because gaps, for me, the way that I use gaps is I think of them as kind of an anchor point, as a support range. So as we have pulled back today, right, if we do pull back, that's where I would look for potential support. That's where I might add to an existing position as long as we make a nice low, a higher low within that range. So overall, right, we've had a nice pop. We're a bit overextended. However, the primary uptrend remains positive. So I assume like chart like that is innocent until proven guilty. Great questions, folks. And sorry I didn't get to all of them. I will certainly put the ones I did not get into the chart, this mailbag. We'll do a mailbag episode later in this week. I'll look forward to answering one of your questions there. But for now, thank you all so much for live streaming or watching the replay wherever you're at. I appreciate you. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it is always a good time to own good charts. Have a good night.